Now, natural gas prices haven't risen much in recent months here in the United States, but they have skyrocketed more than, get this, 700% in Europe since the start of last year. Now, many nations around the world have been trying to transition to natural gas as part of their way to pursue cleaner energy. And that's something the Biden administration has also been pushing in its effort to combat climate change. With this spike in natural gas prices, Europe now appears on the brink of a recession. For more on this and the economic outlook here on the home front, Colby Smith joins me now. Colby is the U.S. editor for the Financial Times. Colby, so break it down for us. How does Europe's, it can only be described as astronomical spike in natural gas prices stand to impact American consumers, if at all?
So it's an immediate and urgent problem in Europe, to say the least. But in the U.S., it's actually quite a more limited impact here. And that's really because of what's been driving this spike in natural gas prices in Europe. So we recently had some new developments out of Texas where one of the facilities there was taken offline, and it's expected to be offline for longer than expected. Now, in the U.S., that led to a drop in natural gas prices, whereas in Europe, it's really helped to kind of bid things up more substantially. So, in fact, it is a quite more limited impact than one would expect. But that being said, it does contribute a lot to global inflationary pressures. And given the magnitude of the inflation situation in the U.S., anything that is bidding up price pressures is an unwelcome development.
So let's talk about gasoline prices here in the United States. They have dropped on average about 25%, or no, not 25%, 25 cents per gallon in recent weeks. The average for regular is about $4.78 today. That's according to AAA. So, big question, hard to answer. Is that downward trend likely to continue?
So that is quite a tough question. I think any economist these days would be quite hesitant to call any kind of peak in gas prices. But what we are seeing is certainly a positive development on this front, especially after gas prices on average reach this pretty, alarming above $5 level on average across the country. And we know that many, states and cities across the nation were experiencing things that were much more significant than that. That being said, the expectation is that we might see continued declines in gas prices, just given the fact that we've seen energy prices more broadly, especially this week in particular, drop quite significantly. So that is likely to feed through to a certain extent. But, I don't want to kind of go out on a limb and say that, we're done with high gas prices here, just given the extent to which those prices are determined by external factors such as the war in Ukraine and other potential developments. There's really the susceptibility to external shocks that we haven't seen in quite some time.
So speaking of external shocks, let's talk about inflation. It currently stands at 8.6%. The Fed meaning the Federal Reserve, wants to combat inflation by raising interest rates. But I've read, and other economists have said, there's only so much the Fed can do, and if it goes overboard, meaning overreacts, that could hasten a recession. What are you seeing? What are you hearing?
Absolutely. That's very much the risk that we're hearing, not only on the Hill, but economists across Wall Street and here in D.C. in particular. So the concern is that, there's only so much that the Fed can do in terms of taming some of these inflationary pressures, given they're in large part driven by supply-related issues, whether it's tied to the war in Ukraine or COVID lockdowns in China that have further gummed up supply chains. So, but where the Fed can be effective, and I think this is the point that Chair Powell, who chairs the central bank, is trying to emphasize here, is that there are things that the Fed can do on the demand side of the equation. And we've seen consumers out there spending quite significantly on goods and increasingly more on services. And the hope is that by the Fed raising interest rates, it helps to dampen some of that demand and in turn allows supply to more easily catch up to those levels, and we see some kind of equilibrium. But it's not going to be an easy task, to say the least, and it really does seem like recession risks are rising.
To that point, recession risks rising. Bloomberg has put the odds of a recession between now and the next 6 months at 35%. Now, the White House routinely insists a recession is not inevitable. That's the quote, not inevitable. But there are rumblings in certain economic circles that the recessionary train has already left the station, meaning I've read some people say, well, it's not statistically one yet, but we're in that kind of climate. What are you hearing?
Absolutely. That's definitely the direction of travel. I think people believe that we're heading in to a certain extent. And you're already seeing some softening in economic activity on the margins. If you look at the housing sector in particular, prices have declined quite significantly just in recent weeks as mortgage rates have increased. And at the same time, you're seeing consumer sentiment and confidence more broadly really sour as people anticipate a period of slower economic growth. So the big concern here is that the Fed historically has never really been able to tame inflation without causing a widespread economic contraction. And that's simply because its monetary policy tools are quite blunt. They can't specifically target the sectors, let's say, that are seeing pretty significant price pressures. They just enact one sweeping interest rate increase, and that has, widespread effects on the economy at large. So the real concern is what happens on the labor market here, which is coming from a period of quite significant strength, with job openings, as today's data show, still quite elevated. But given the extent to which inflation is above the Fed's 2% target and how much they will need to do in order to bring it down, I think expectations are that unemployment is going to rise, quite significantly from these levels.
Colby Smith of the Financial Times, we thank you.